Hi, this is Gerald Gayton, your mortgage doctor. I'll show you how to take the pain out of getting a mortgage. This channel, I'll show you how I use my 20 plus years of experience to make sure that I save you time and money with sharing insider tips with you. Now, today's question is, how is my interest rate determined? Now, this is one of the most important questions, and I want to tell you to really pay attention, because if you understand this segment, you're going to understand quite a bit about the mortgage process. Now, the way that your interest rate is determined, I use the acronym CADS. C-A-D-S. C stands for credit, A stands for affordability, D is down payment, and then S is stability. So let's talk a little bit about the C. Now, the first thing is, when you're talking about credit score, when it comes to mortgages, that's going to be your actual middle credit score. So we're going to pull a score from each of the three bureaus. Your middle credit score is going to be your credit score. So I oftentimes hear people say, my credit score is 700 plus, which is great. But if that's not the middle score, that's not going to be the one that's actually used. So you want to make sure that's your middle score. Now, in addition to that, if you have more than one borrower, your middle score or your credit score is going to be the middle score, the lower middle score for the actual borrower. So let's say it's you and your husband or wife, two people are qualifying. If one person's middle credit score is above 700, we'll say 720. And the other person's middle score is a 620, your credit score for mortgage purposes is actually going to be that 620. So it's the middle score, the lower middle score, if there's more than one borrower. So that's credit score is only one component. Now, when you talk about the credit arm, you're also looking at the credit development. And by credit development, ideally you want to have at least 3 accounts, one over $5,000 at least, and 24 months of development. So it's not just the credit score, it's also what type of accounts you have, how long those accounts have been developed. If it's less than 24 months, and when you're talking about mortgages, everything is in 2-year cycles. So how does that credit look for the last 2 years? Are there any lates? Are there any collections? Are there any judgments that have happened in the last 2 years? All of those things can have an impact on how you qualify with credit. So it's credit score, credit development. For the last 2 years, make sure everything is crystal clean. You won't have a problem. So now when you look at affordability, affordability really has to do with making sure that whatever you purchase, it's a sound investment for the lender and it's a sound investment for you. Now, there's some room to kind of go around on this, but a good rule of thumb is 40%. So that means for every $1,000 that you make, so let's say you make $5,000 a month. For every $1,000 that you make, only 400 of it can go towards your house payment and all your other debts. So now when I talk about the other debts, that is excluding things like your utilities, so your gas, your electric, your cell phone bill. None of those things are going to be incorporated into it. But if it's a credit card, if it's a car payment, generally anything that's going to show up on the credit report and or anything that has more than 10 payments is going to be part of that calculation. So you look at that, and when you're talking about affordability, you're going to have 2 ratios you need to be concerned with. You'll hear a front side ratio or debt to income ratio and a backside debt to income ratio. Ideally, that front side needs to be about 28%. So $280 for every $1,000 that you earn a month. Now, when you include that mortgage payment, it can't be over $400 per month. So I'll show you a very simple way to figure out what you can afford. I said you make $5,000 a month. So 400 times 5 would be $2,000. That would mean you could have potentially $2,000 of affordability. Now, from that number, all you have to do is deduct what you currently pay. So let's say you have a credit card for $100, a car payment for $300, and a student loan for $100. So 100, 300, 100, that equals 500. Deduct that from the 2,000. That means you have $1,500 of affordability for a mortgage. That's a very simple way that you can figure out exactly how much you can afford. Now, one thing that's really important to note is when I say mortgage payment, you need to make sure that is taking care of the mortgage, the principal and interest, taxes, and insurance. And we'll get down to the details of what a full mortgage payment is in another segment. Stay tuned for the D and the S. You've heard credit, you've heard affordability. This is Gerald Gayton, your mortgage doctor. I'll show you how to take the pain out of getting a mortgage.